We are here at Austin Blockworks Permissionless event, and I'm joined by Jim Bianco of Bianco Research. First, I want to say a huge thank you to Kraken for letting us record in their podcast studio, which if you're watching this and listening to it, you can see how incredible it is. And we got the logo in the background. Jim, we just came off a panel with Yuri and Timur of Fidelity and Mark Yusko. I want to ask you, is the Federal Reserve done? Interest rates, short-term interest rates, 5.5%. Do they have another one in the chamber? Do they have two? And then when are rate cuts coming?
Right. So let me answer the question in two ways. We're recording about a week before the next Fed meeting, and that would be the September 20th meeting. And the market is putting about a 7% chance that the Fed's going to raise rates.
It's not happening.
Right. Yeah. 93% chance they're not going to raise rates. I agree with that. I think that they're going to pause, if to use their phrase, at the next meeting. The next meeting after that's November 1st. The market is putting mid-40s, 45, 44% chance that the Fed will raise rates. Let's call it what it is, 50-50. That's a coin toss meeting. I think the Fed will raise rates at that meeting. Now, what happens after that? The consensus thinks the Fed's done raising rates. I'm not so sure. I still think that the inflation problem that they're worried about, I think inflation bottomed in June on a year-over-year basis. I'm talking about CPI, headline CPI, at a year-over-year basis at 3%. It went to 3.2 in July. August is expected to be around 3.6, and it might even continue to trend towards 4% by the end of the year. That's what economists call a base effect, because the numbers from a year ago were very low, the inflation numbers. The numbers now, because especially with oil prices up, are going to be higher. That might get the Fed to, at a minimum, dash the hopes that in 2024 that there will be rate cuts, but might still see some more rate hikes into 2024. So I'm not completely convinced that A, they're done, or if they raise rates in November, that's it as well.
And how much does the price of oil play into that? Price of oil, $120 in June of last year, went down to as low as $66, $67, I think, for WTI. We just checked, it's at 89. So in a few months, you've had a $20 rally, and that's such a volatile component when it comes to inflation. Do you think the Federal Reserve is going to respond to that, or are they more going to focus on that core inflation, which strips out energy and food?
No, they'll respond to the core inflation number. But there's two things to keep in mind about oil. That is the basis of energy, and all economies run on energy. If the price of oil stays up, and I think it will, that will eventually feed into manufacturing processes, transportation costs, things that are in core inflation. It won't be in the August number, won't be in the September number, but eventually it will filter through into some of those numbers later in the year. As far as the headline number goes, look, when you ask the average person, what's the inflation rate, they usually quote you whatever they see at the gas pump. And will see that oil is up. Now, economists will say, well, that's oil, that's OPEC, that's idiosyncratic to the oil market. It's
not rates, not core money supply demand.
Right, exactly. So we could look past that, sort of. You can look past it if you don't want to raise rates, but I don't think if the price of oil is up, the Fed could say, we're so going to look past this that we're going to start cutting rates. It will keep them higher for longer. Because if they start cutting rates in the face of higher oil prices, they will get skewered by the media that they're not responding to inflation because the public thinks inflation is pretty much the grocery store and the gas pump.
Yeah, I've always been skeptical of the narrative that the Federal Reserve is going to cut rates when the economy is doing fine just to help out the stock market. I expect that to not occur. But I just want to go back.
Can I jump in on that? If you look at the cycles in the stock market for the last 30 odd years, when does the Fed cut rates? Well, in the 90s, they cut rates in 95 and they cut rates in 99. And those were, if I could use the phrase, those were victory cuts. We vanquished inflation. We accomplished our job. We can now start backing off on the rate cuts. Well, in 95, the S&P went up 37% in 10 months. And in 99, the NASDAQ went up 85% in a year. And the Fed said, or the Fed kind of acknowledged, we kind of sent the animal spirits, running by cutting rates. The last 3 rate cuts, 2000, 2008, and 2020, came about as a panic because the economy started to fall apart and they were trying to stop a recession. So I've always been of the opinion that the Fed learned the lesson of the 90s, even though Powell wasn't there, the staff was, that the next time they're going to cut rates is when they see serious weakness in the economy. It won't be, we did our job, we can now back off on rates. We did our job and we don't need to be as restrictive. Fed Governor Waller gave a speech the week before we're recording, in which case he talked about, do we need to cut rates? He said, well, we've raised rates this much and the economy's strong, the stock market's up. It doesn't seem like these high interest rates are hurting anything. So why are we in any hurry to pull back on it? And I think that's that higher for longer narrative. Only when things start looking bad will the Fed actually start thinking about cuts. And that's not 2 bad days in the stock market. And that's not just one payroll number that kind of comes in below expectations. You will, it's like the definition of pornography. We'll know it when we see it, when things go bad and stuff.
Yeah, if and when there's a slowdown in the economy, the R word, a recession. Where are you on that front, Jim? 99% recession probability assigned by Bloomberg Economics last fall. We're not in a recession now. Unemployment rate still below 4%. Obviously, that's a lagging indicator. A lot of folks, and I've been speaking to really smart economists and analysts who expect a recession in 2024, and they say just because the tightening hasn't caused a recession yet doesn't mean it won't. Where are you on that spectrum?
Well, let me back up and say that in 2022, we had the first and second quarters were negative GDPs. That has been widely considered to not be a recession. By the way, what is a recession? There is actually a business cycle dating committee of 6 PUBA economists, and a couple of them are actually very good economists. And they get together and they proclaim that this was a recession. It wasn't. And some of those economists on that group, Bob Gordon of Northwestern University, who I happen to know very well, they've already said that they don't think that was a recession. Now, I'll disagree with them. I actually think it was, but I'm quibbling here a little bit. If nothing else, that was the only time in American history you had 2 negative quarters of GDP. That wasn't a recession.
Wouldn't it also be the only recession where unemployment continued to go down and rather than unemployment going up?
Yes. If it was a recession, you never had a negative payroll number. That's one of the big arguments as to why that wasn't a recession. But it was definitely a slowdown. And of course,
it was a slowdown for sure.
Yeah, it was a slowdown. Maybe it was a soft landing. But I think that was the weakness, and we're on the rebound from that weakness. That might not necessarily be bullish. Oh, we had the slowdown of the soft landing last year. We're cool. We got 4 years of no recession. We're off to the races. Not necessarily, because if, as I said earlier, the inflation rate had bottomed in June, it starts drifting towards 4, the economy stays reasonably strong, payroll numbers stay reasonably strong, the argument is sticky inflation. The argument is no rate cuts, maybe more rate hikes, as I argued. Then the stock market has the competition of higher rates. Remember, all investing is a choice of alternatives. It's, do I get into the stock market or don't I get into the stock market? It's, do I get into the stock market compared to what? Well, in 2019, it was compared to 0 in a money market fund. 2023, it's compared to 5.5% in a money market fund. That's a gigantic difference. Long-term studies done by Ibbotson and Associates in the University of Chicago say the long-term, many, many years, the stock market should return 9%. Money market funds, which have no risk, are giving you 5.5%. They're giving you 2/3 of the gain of the stock market with 0 risk. So if rates are going to stay up, that is going to change the calculus for a lot of investors, because I can get more than half of what I was hoping to get over long periods of time and sleep at night. Nothing, as opposed to owning this thing called the S&P 500 ETF or something like that, and it might do like it did last year and lose a quarter of my money again. So not necessarily by saying no recession, I'm also saying stickier inflation and potentially higher interest rates.
So that argument that higher interest rates should somewhat mechanically reduce the value of equity, and because now you have a competition, your cash yields something, that makes a lot of sense to me now, and it made a lot of sense to me in October of last year as the Federal Reserve raised interest rates so rapidly, and the stock market didn't crash, but had a continued decline in equity prices that were quite substantial. But as you know, the stock market has been on a tear, and as the Fed has continued to raise rates have been going higher. The stock market has been going higher as well. So, how do you explain that? And are you someone who says, long term, the theory that high interest rates are not good for stocks, that will hold play? It's just that so far it hasn't played out.
We have to really look at the way that the stock market has rallied this year. There's 7 stocks, Facebook or Meta, Apple, Amazon, Netflix, Google, Tesla, NVIDIA, Microsoft. I actually named 8 there. Take out Netflix, but those 7 are referred to as the Magnificent 7. The S&P is up 16, 17% for the year. They're 11, 12, 13% of that 16, 17%, those 7 stocks. So it has been, by some measures, the most concentrated rally that we've seen in at least a generation, if not half a century, because such a small handful of stocks is most of the gain. Let's look at the Russell 2000. That is a small cap index. That is stock number, looking at stocks in their sizes, market cap sizes, that's stock number 1,001 to 3,000. Those companies, that index, are up mid-single digits for the year, 5, 6, 7%. All of a sudden, let's look at what's referred to as the Russell Microcap. Yeah. That's the bottom 1,000, so company number 2,000 to 3,000. That, as of late last week, was still down on the year.
Yep, and I think the Russell is down. It peaked in February.
Right. So it has not taken out its February peak. So my point is that higher interest rates is impacting a lot of companies, except for 7 companies that are all wrapped up in 2 letters, AI, artificial intelligence. They're running on their own cycle and their own hope and dreams about whether or not artificial intelligence and what it means and doesn't mean. But the rest of the companies that aren't AI generated or AI based kind of companies, like auto companies, consumer product companies, manufacturing, industrial companies, they're looking over at higher interest rates, and those companies, and they didn't do very well last year, and they're struggling to really rebound. So yes, interest rates are having an impact on the market. Now, most people buy broad-based ETFs like SPY or QQQ. They're all happy because they've got this handful of stocks that have taken the whole index with them. I understand that.
And that is a good thing about passive indexation, is that, the winners become a greater percentage,
Right.
It automatically waters the flowers.
But you have to be careful that there might be a period in the future where those 7 stocks falling apart are dragging everything down with them. And you're going, but everything else is okay. Yeah, well, now you're getting the other side of that story that you had in 2023 where the 7 stocks brought everything up.
Yeah, so I hear what you're saying, that it's been a narrow rally, large cap stocks leading the way. And that typically when you have a bull market and everything is rallying, and then only 70% of the stocks are rallying, and then only 50, and then only 30, that precedes a bear market. But we didn't have that. We came out of a bear market, and the narrow stocks are leading us out. Like in April 2020, I bet it was probably pretty similar, of this Apple and Microsoft leading the way. And then that made room for the sort of more speculative stocks.
Right. April 2020, June of 2009, March of or October of 2002. These are the bottoms of the last 3 bear markets. You're right. A handful of speculative stocks go, but eventually the rally broadens.
Yeah.
But this one really hasn't broadened like we've seen with the other ones, because what's unusual about this case is this has come about with the Fed being uber aggressive raising interest rates. In 2002, they cut rates to an unfathomable level at that point, which was 1, and they held it there for 2 years while the market took off. In 2009, they cut rates to 0, Europe went negative, and they held it there for 6 years, and then the market took off. But now they are raising rates throughout the bear market and they're raising rates throughout the recovery. And if we just go with, my opinion, there's going to be more rate hikes, but the market's still 50-50 that there's still yet another one coming before the end of the year.
So if rising rates, higher interest rates, not good for stocks, why are they not bad for the economy? And how much of the lag do you think has been felt in the economy from 0 to 5.5%?
Well, that's a good question because, the big question is, what is the appropriate level of interest rates for an economy?
R-star.
Yeah. Should it be, that R-star is different. Yeah. R-star is only different in that that's the Fed funds rate.
Mm-hmm.
I'm talking about long-term interest rates.
Right, yeah.
But, should it be 1? Should it be 20? Should it be 10? Should it be 5? What's the right number? The right number is conceptually is whatever nominal GDP growth is. What's nominal? That's the inflation rate plus some real growth rate. Well, if the nominal growth in the economy this year looks like around 6%, some quarters better, some quarters worse, but around 6%, that would tell you that 10-year yields and stuff, they should be somewhere around 6%. Now, that might be a little bit high. So maybe we back that off a little bit to 5 or 4.5.
And they're at 4.3 now?
4.3 or 4.2. The point that I'm trying to bring up is interest rates might not be that out of line. They might not be that restrictive. Mm-hmm. That big rate rise that you saw, I'll stick with the 10-year note. In August of 2020, it was at 50 basis points, 0.5%. Today, it's 4.3. Maybe most of that rise has been because of extra inflation and higher nominal growth. Interest rates have just been following its fair value higher, and they really haven't gone to that really restrictive level yet. So that's why all these rate hikes, and this is why economists keep saying we're going to have a recession in 6 months, because they look at how much rates went up.
The backward models.
Yes, look at how much rates went up. That has to hurt the economy. Rates matter. You're right. Except if all it's doing is following nominal higher, it's not as restrictive as you think it is. And that maybe this is why the economy is able to weather this. And it might take even higher interest rates to become restrictive to slow things down. That's my fear, is that it can't handle these rates. We are going to have stickier inflation, and we're going to have to realize rates have to go even higher to bring that inflation rate down.
So your view that we wouldn't have a recession, I remember you shared this with me in January and probably earlier. It has aged very well. We are not in a recession. The unemployment rate is still below 4%. But what I just spoke to Eric Basmajian, and he's firmly in the recession camp. He's looking at cyclical indicators, things that typically are leading indicators, such as manufacturing employment, trucking, construction, and all of these things are slowing down. And the boom that we're having is in travel. I mean, it was kind of difficult for me to get here on a plane, and the airlines aren't treating their passengers, that well, because they know they have all the pricing power. Obviously, the economy doesn't run on just airlines, but there is a huge travel boom, and the experience economy, spending on services is off the charts. But spending on goods, which is, as Eric points out, is typically more leading. That especially in real terms, is lagging, and it is really struggling. So, do you think that this will is that worrying that this so-called leading indicators, and we could also talk about the inverted yield curve, are hinting at a recession? Yeah. Well,
the short answer is yes. It is concerning. But let me back up and give you an assumption that I've been working with since 2020. We did something extraordinary in the spring of 2020. We shut down the global economy, and then we restarted it. We rebooted the economy. Mm-hmm. My argument has been that after the reboot, the economy is fundamentally changed. And I'm talking global economy now. It is not what it used to be. You hear a lot of people on Wall Street talking about normalization. Normalization means going back to the way things were in 2019. We're not. We're a little bit different because that was the economic event of our lifetime. It wasn't 2008. If you're old enough, it wasn't the 87 crash. It wasn't 9/11. It was the shutdown reboot of the economy in 2020. Now that I've said that it's changed, I want to be clear, that's not dystopian. Mm-hmm. That doesn't mean it's worse. It means it's different. And because it's different, I've argued it's a little bit out of line with what we understand. The biggest example I give people about it being out of line is remote work. Mm-hmm. At any given day today, globally in offices, 1/3 of those desks are empty. Those people are working remotely. Where prior to 2020, it was 5% of those desks were empty. That's one signal that something has fundamentally changed with people's attitudes, with the way the economy works. I've argued that in this new era, we have to understand these cyclical indicators. Now, some of the ones you pointed out about trucking and stuff like that, they might still work the same way that they worked in 2019, but others, especially in the labor market, don't. I think more people now in the labor market are more transactional about their job. You know, I'll take a job, I'll do this job for, especially if you're not necessarily in a career-oriented job. I'll take a job at a big box retailer. I'll work very hard at the job for 6 months. They promote me to assistant manager. And then I quit and I go skiing for the winter. And I'll take another job in the spring. That is more common, or the gig economy is more common now than it was 2020. So I think what has happened is the economy's out of line. There are frictions in the economy that is leading to higher inflation that needs to be dealt with. Why does higher inflation need to be dealt with? If you look at a lot of the studies, YouGov did a poll recently in May. Something like 15% of the American public says, and this is confirmed with other studies, they have no savings. Their net worth is zero. They live literally paycheck to paycheck. 50% of the public has a net worth of somewhere between $0 and $10,000. If you add that up, you're at around 60 to 65% of the public has less than $10,000 of savings or no savings at all. If inflation is going to continue to rise faster than wages or around the line of wages, these people just lose. They just lose because they don't have investments. They don't have savings to say things are getting more expensive. Well, I got a lot of money in the bank. I'll just pay a little extra for it because I've got that money in the bank. The Federal Reserve, Jay Powell, understands this. And I agree with him that that's why inflation has to come down and they have to deal with that. But if we're in a post-pandemic economy with these frictions that is holding inflation higher, ultimately the way to fix that is we need to recognize it and we need to restructure. Now, the closest example we have in history of this would be the end of World War II. In that the economy, when the war ended in September 45, the October 45 payroll number was minus 2 million. And that held as the biggest monthly decline until the pandemic. But we celebrated that because those were 2 million people that were working on making Sherman tanks and P-51 fighter planes.
And they shouldn't. We
didn't want them. We don't need them anymore. And immediately the day after that happened, we all said, we have to start restructuring to a consumer economy. And we did. We're in 2023 and we're still arguing whether or not we need to restructure anything. That thing in 2020, that was a one-time event. It's over.
But what needs to be structured other than remote for work? People need to accept that remote for work is here to stay. In terms of between services and goods, in terms of demand, let's
start with two things. Let's start with remote work. That is, not only do you have to restructure the whole idea of why do I go to the office? What do I do at the office? What is the purpose of an office? What are we going to do with these hundreds of billions of dollars of offices? Let's also remember too, pre-pandemic, if you had a service job being defined as you had to go to an office to do something, a white-collar job, you were home 2 days a week, Saturday and Sunday. Today, you're home 4 days a week, probably Saturday, Sunday, Monday, Friday, and you go to the office 3 days a week. You've doubled the amount of time you're at home. Your lifestyle's changed. Your lifestyle's changed because of that. Who knows this more than anybody else is the retailers. For the last 2 years, the retailers have been struggling. Hey, the economy's reopening, the COVID is getting past us. Stock the shelves. People are going to come back to the store. Okay, what do we stock it with? What did we put on the shelves in 2019? And what did we learn? They're not buying stuff in those requirements. We have simultaneous shortages and gluts of stuff at the same time. We have to figure out what has changed. 4 days a week at home versus 2. So the taste, the preferences, the demands that people want, those have changed as well. Now that we've changed those tastes and preferences, now we have to go back to the suppliers. And we have to say, you know, you used to send me red sweaters and I used to call you up and say, I need more blue sweaters, and you'd have them on the boat, you know, from China over here within 48 hours. Well, now I don't need red sweaters or blue sweaters. I need pants. And I don't need pants to be delivered to the Long Beach port. I need it to be delivered to the Charleston port. And what
Yeah.
we're told by the suppliers is 2 years. It will take me 2 years to ramp up from sweaters, different colors, to pants, and move them from the Long Beach port to the Charleston port. The supply chain is very robust within channels, but we're now talking about taking it and putting it in a different channel.
And you think that the supply chain issues have not been solved?
No, they have not. As a matter of fact, if you start looking at some of the supply chain numbers, we all looked at the cost of shipping a container was really high at the beginning of 22.
And now it's probably back to 2019 levels. Probably.
Yeah, but it's up like 50 or 60% in the last 6 months from a very low level, but it's heading back up again. The supply chain is going to be very volatile and highly cyclical. What would help is if we had that 1946 mentality. You know what? This is a post-pandemic economy. This is different than 2019. Stop waiting for normalization. Let's figure out how to restructure this economy. Instead, we want to argue, do we need to restructure it? Do we just need to wait? Things are returning to normal. Normal, again, is it's like it was before 2020. The implication there is that was a one-off thing and it didn't have any lasting consequences to shut down, restart the economy. Those lasting consequences alone of remote work are the biggest things that have happened to the labor market since we invented the 8-hour workday, 5-day work week in the late 19th century.
And the 20 million layoffs in March and April of 2020. I mean, there's so much volatility. Like, in finance, it's often said that it's dangerous to say this time is different because that's what you say at the peak of a bubble, and then this time isn't different. But Howard Marks, I think it's he who has a great quote that 20% of the time, it is different. And you're going to be wrong if you don't. And I think a reasonable case can be made that, in 2020, you shut the entire global economy down, you print tons of money, and you don't only just give it to the banks and corporations, you give a lot to them, but you give it to everyday people.
You mailed it to them.
Checkable deposits went up some 80, 90%. And 20 million people laid off, and you had a very tight, very lots of slack in the labor market, tons, unprecedented. And now you have a very tight labor market as the economy reopens and demand, and everyone wants Pelotons, and now no one wants Pelotons, and everyone wants red sweaters. Total lots of volatility. But when it comes to those leading indicators, durable goods spending, the rate of growth, a somewhat recession, a somewhat manufacturing slow session, let's call it, and that typically leads to a broadened recession, and the yield curve inversion. Why everything you just said? Why is it the case that make the case that it's different this time? We're setting aside remote work.
Yeah. So the other thing to keep in mind too is that the total economy, GDP, nominal, that's with inflation, is approaching $30 trillion in the U.S. 25 to 30 trillion in that, which depending on which measure you use. When you start seeing the economy that big, relative to what it used to be, you can have multi-trillion-dollar sectors of the economy, manufacturing, transportation, have a very difficult time, and they could be in recession. But you could have other sectors of the economy, especially in the service sectors, booming.
Travel.
Healthcare. Healthcare's always been a very strong part of the economy and offset that. And that in total, the economy continues to move forward. So a lot of those indicators can be correct, that maybe manufacturing, maybe transportation, and some are going to experience. Banking is probably experiencing a recession right now. But there are other sectors of the economy, tech, AI, healthcare, which are multi-trillion-dollar sectors too, that are doing very well, and there can be an offset. And that's why you might not see that global slowdown that a Federal Reserve would want to see to back off on interest rates. So what you have is you have a constant economy that's some parts are constantly in recession, some parts are constantly in a strong recovery, but overall you might not be yet at a point where you see the whole economy slowing down. What has been the hallmark of an economy that has gone into recession in the last 30 years? It has been a financial crisis associated with the two. Some sector goes bad, the markets freak out, everybody changes their behavior because the markets freak out. I'm talking about like 08 and in 2000. A lot of what happened in 08 was the housing sector went bad. Okay, but everything else was okay. But the banks fell apart. The stock market fell apart.
And everyone owned these things, and they were funded with short-term liability. It was a true financial crisis.
Right, and that financial crisis, even if you're not a banker, if you're just a housewife in the middle of the country, holy crap, look what's happening with the economy. I better stop buying things. I better change my behavior. And then the whole economy goes down. So what I'm saying is you're going to see rolling recessions. But what is the hallmark of an economy that overall goes down? Something worse than last year is what you need to have happen.
So that is a really convincing case that maybe we have a slowdown of sort of vanilla recession, but a type of recession where a 2008 style recession or a 2020 when it was caused by an exogenous force, I don't see that exogenous force. And, maybe that's the sign that it actually is to come, the black swan, when, you have a podcaster saying, I don't see anything, but I don't.
Let me back you up.
Yeah,
okay.
yeah.
So the 2020 was an exogenous effect with COVID. 2008 was an exogenous event with the housing crisis falling apart. The recession before that was 2001.
Which was mild. Stock market decline was severe, but recession was mild.
Right. 2001, the recession was so mild in 2001 that some of those same economists on the cycle dating committee say that after the fact that might not have been a recession.
Oh, wow.
But it is still, they called it a recession, and it is. But 2001 was 9/11, and then if you go before 2001, you got to go back to 1990. That was the recession before that. 1990 was Iraq's invasion of Kuwait.
Oil spike.
And the oil spike. Remember, oil went from $7, $8 to 40. It went up 400%. If you go back before that, you had the inflation spike of 1982. You had two recessions real quick in 1980. So, and then if you go back before that, you had the OPEC.
74.
74 was the recession before that. And that was the OPEC oil embargo, or the Arab oil embargo, as we called it at the time. What I'm trying to bring up is, I'm not going back 50 years.
Yeah.
When is this garden variety recession that people are talking about?
Yeah. It's always something special.
There hasn't been one of those for at least 50 years. And so I don't know what this garden variety recession is that people are looking at.
Well, I guess 81 and 82, you could say
it was 14, 15% inflation, 15, 16% interest rates.
Yes. And interest, but I mean, some people say, going from 0 to 5.5 is as severe as going from 7 to 15.5. I don't know if I agree with that, but
it also comes back to nominal growth in the early 80s. My argument, that wasn't that high. Those were restrictive rates.
Yeah.
Where 5.5% in a 6% nominal world might not be as restrictive now as people think it is. It is definitely, the speed of the move is definitely huge.
Yeah.
And the relative move is definitely huge. But is it hurt? I'll come back to Chris Waller again. Chris Waller, Fed governor, has given that speech, and he said, economy's okay. The stock market's okay. We keep printing 200,000 plus jobs a month. Where's this pain that everybody's talking about? And if there isn't, where's this demand that we have to cut rates?
Yeah.
And so that's the argument, is that now maybe, the people that are forecasting recession would say, it's coming. You wait 6 more months and you'll see that pain. They've also been saying that for about 18 months.
That's true. Yeah.
So we'll see. I mean, it doesn't mean that they're wrong because it's been slower to unfold.
Yes.
I just don't see it. But when they do see it, then you should expect to pivot.
And the pain that Waller said, you're not seeing it on the borrowers, corporate credit. There's a lot of people, the corporate sector and individual homeowners, the consumers, they termed out their debt, and consumer debt as a percentage of income is actually quite small. I mean, just the narrative is, oh my God, debt, everyone's so levered up. But actually, 1985 to 2000, that was the huge levering up of the consumer. Like, it's been pretty flat over the past 20 years as a percentage of income or GDP.
Keep in mind that,
or even down.
After the financial crisis of 2007 and 9, a lot of the consumer sector and the business sector delevered.
Yes.
It was the government sector that levered
a ton.
Yeah. And so they were coming into this at a relatively delevered spot. I'm old enough to remember, if you went back to 2005, 2006, the national pastime was not baseball, was not football. It was refinancing your mortgage.
Yeah.
Is what it was. Everybody, you'd go to the cocktail party, go, did you see the Super Bowl last week? No. But I tell you what I got on my adjustable rate mortgage. That was the national pastime at that point. And then the housing market blew up because we kind of overdid it. And so we delevered. So we weren't necessarily in that same position like we were in 2005.
Yeah, and maybe I'm a conspiracy theorist. I was not old enough to remember that. But looking back, Fed cut rates to 1%, I think you said. Mortgage rates went down, to some marginal spread above that. And so many people refinanced, and banks who owned mortgages or mortgage-backed securities who thought they were going to get that income, they get paid $100 back, but they bought it for $105 or $110.
Right.
And maybe, who knows, maybe that's what pushed them into subprime, because that was some safer on the duration front, although way more dangerous on the credit front. We have the same issue right now with the duration, right? I mean, you've been somewhat bearish on the banks for quite some time, and banks are having a lot of issues with the mortgage-backed securities, and mortgages are underwater. They're being paid lowest mortgage delinquency rate ever on credit. It's totally fine, at least in the data so far, but they're just being paid 3% is just not cutting it when rates are at 5.5%.
That's right. And what's been happening with the mortgage market is these banks buy a lot of these securities, as you said. When interest rates go up, the price goes down. They're sitting with an unrealized loss. They have to show that unrealized loss, and it hurts their profitability. They've also got the problem of what I call the bank walk. Mm-hmm. And the bank walk, it's not a run. It's not, oh my God, get out of the bank before it fails. They're not failing. But what people are doing is they're starting to see that the banks are paying them 0.5%, 1%, 1.5% on their money in their bank deposit. And money market funds are paying 5%, 5.5%. And now we got this new technology. We got your phone.
Yeah.
And what you could do with your phone is you could pick it up and you could transfer your money to a money market fund in 5 minutes. So the banks are seeing their deposit base leave for a money market fund. Now, if they're a big enough bank, it might be from Chase Bank to Chase Securities, but it's not the bank.
From E-Trade to Morgan Stanley.
Right, yeah, because Morgan Stanley owns E-Trade. Yes, it could be going from that as well too, but it's not Morgan Stanley. And so a lot of these banks, to keep the deposits in the bank, have to start raising their deposit rates, and their net interest margin, the difference between what they have to pay their depositors and what they get from their people that borrow money from them, has been collapsing. So the bank walk is not get away from the bank because it's going to fail. It's I'm walking away from low interest rates, and it's squeezing their profitability. And that's why the bank stocks have been suffering, because we look at their business model and go, where are they going to make money? They have to continue to raise that cost of funds that they're getting from their deposit base. And they can raise interest rates on the people that they're lending money to, but only so much. They're already there anyway, and now they have to start raising their deposit rate.
Yeah.
What's different, again, to use my prop again, is did this exist in 2005? Yes. But if you said the bank's paying me 1%, I could get 5.5%. It's exactly the same number in 2005. You had to take a day off of work. There was no remote work. You had to go to the branch and you had to fill out a bunch of forms. And as I like to jokingly say, and then you had to wait a week, and then the branch would tell you that some of the forms were filled out wrong. You had to come back a second day.
Take another day off.
Yeah, fill them out again. Nobody did that.
Hire a babysitter.
Yeah, no one did that. Now you go on your phone for 5 minutes and boom, you're in E-Trade and you're getting 5.5%. That's why the bank walk now is much different than the bank walk was then. We pushed everybody to the technology of using banking apps. 120 million people a month use a banking app, mostly for transferring money and paying bills. We're talking about transferring money here. It wasn't an issue because the Fed squashed interest rates at 0 for 12 years. Well, now that we got 5.5% of money market rates and banks are trying to hold deposit rates at 1%, it is an issue.
Yeah.
And that's why we're seeing money bleed out of the banks every month. Again, doesn't mean a bank fails. It just means where are they going to make money? That's why their stocks are down is so much.
And banks, the reason people said banks make money when interest rates rise is because the idea of they're very asset sensitive. They're credit cards and auto loans that are floating rates, and you can always turn them over. So at 5%, you're gonna make a lot more money than at 0%. But banks, honestly, they really resemble the thrifts of the 1970s and 80s because of the refinancing in 2020. Bank of America bought $500 billion worth of agency mortgage-backed securities, and their unrealized losses on that is $100 billion, and they're going to make that back because they're holding interest rate. Their deposit costs are going to be much lower than what they could do on new loans, and Bank of America is definitely going to be fine, but it's just they're
going to be fine as a bank. They're going to be fine as a place to deposit your money.
Yeah.
Are they going to be fine as a stock? Because all stocks are about cash flow or earnings and what you expect them to make in the future. Discounted cash flows. There, you could argue that the earnings of the bank might be suffering from here and that the stock won't necessarily appreciate as an investment. But no, if you want to hold your money there, that, I wouldn't be worried that somehow you're going to be trapped like we were worried about with Silicon Valley Bank in March, that you will be unable to access your own money. That's not the, that's why I like to use the phrase walk, where a run is a panic because the bank is going to close and I won't be able to get my money.
Yeah, I think if you're right that we don't have a recession and credit losses remain very low, which they have been, I said about mortgage delinquencies, lowest on record. I actually think some banks could do well, just because they'll make a lot of loans at higher yields and then they'll reprice their book.
Right.
But yeah, if we have a credit issue, then that's a whole nother story.
Right, and you never know when a credit issue is going to pop up, because usually credit issues come up because of a mistake somebody made, and it's not very obvious where the mistake is. The last mistake that they made was with, the apps in the bank walk, and it really didn't show up until the spring. But if you think about the way I've explained the bank walk, you could say, that makes a lot of sense. That's very simple to see. How come we weren't talking about it in 22? How come we weren't talking about it in 21? Because there's a lot of things that once they unfold, you say, the signs were there. We just didn't pay attention to those signs. And a credit issue is kind of like that too. There's always signs that there's going to be a credit issue, and a lot of them aren't. Yeah. But eventually one of them is, and you go, well, we should have known it. Yeah, and the 12 others that never happened either, we should have known that those were going to be credit events.
And so yields on bonds and loans are high because the Fed raised rates, but the spread over those risk-free treasuries are very narrow. You know the data, I don't, but investment grade bond spreads, narrow, high yield bond spreads, narrow, close to as narrow as they were in 2021. Leveraged loan spreads, interestingly, pretty wide because the banks are having some issues. But if you were, I talked to some fixed income strategists, and you're either, if you think the economy is going to slow down, you're long duration and overweight duration, underweight credit. If you think the economy is going to boom, you're overweight credit risk, underweight duration risk. Where would you be on that spectrum?
Well, the one thing I was going to say, when you talked about leveraged loans, those are bank loans. You're right. When you look at credit spreads, market-based spreads, high yield spreads, investment grade spreads are very, very low. But when you look at bank loans, if you need a bank loan, those spreads are very wide, and they're getting wider all the time. And that's because of the bank walk. The banks need that bigger spread to hold their net interest margins. And that's why those microcap companies are suffering so much, those one company 2,000 to 3,000, because some of those companies, if they need to borrow money, they don't necessarily go to they don't call an investment banker to issue bonds. They go to a bank for a loan.
Which is shorter term. They didn't, Amazon issued 40-year bonds in 2020, 2021. They didn't do that. They borrowed from the bank. And the bank, they roll over their loans, every 3, 5, 7 years. Yeah.
Yeah. And in an Amazon and a Google and an Apple, they're not only are they issuing 40-year bonds, they're issuing them at about the same rate as the government, the United States Treasury, because people think their credit is almost as good as the U.S. Treasury's credit. So they don't really have to pay those kind of very, very high rates. But that will definitely, there are issues out there. And maybe there is a credit issue that comes along right now.
All right, so just going to that fixed income point about how does that align with your macro framework about credit risk versus duration risk in the bond market. And I'll also point out, like, agency mortgage-backed securities, which were at the scene of the crime for Silicon Valley Bank, they're actually trading at the 99th percentile widest spread to treasuries, even though they now have positive convexity, which I think has never happened.
Right.
Yeah.
Right. Well, see, that will be the thing, is that I think what's holding interest rates up is the Fed, which is duration, if you want to use the bond market parlance, that's pushing those rates up, not credit, not the spread on credit. Well, what could very well happen in a downturn is the Fed will push down interest rates, and then so the duration will come down, but then the credit spread widens.
Yep.
But what I'm saying is the composition changes, but the overall level doesn't.
Oh, okay, yeah.
Yeah, the overall level, it will come down not nearly as much as people want. Because keep in mind, if we are in a 3% inflation world, a 2% inflation world, something greater than a 2% inflation world, gone are the days of 2019 where the Fed would say, next recession, we cut rates to 0. Mm-hmm. They cut rates to 2.5. This is what they wind up doing. They don't go all the way back to 0. Well, if you cut rates to 2.5 and there's a credit issue and credit spreads really widen, interest rates don't go down as much, or maybe not at all. And so that relief that you would expect the economy to get from lower interest rates may not materialize to the degree that they think.
So normally rates would go down to somewhat compensate you by credit spreads. But if you don't think we're going to have a severe recession, maybe investment grade spreads aren't going to go out to 7%. They'll go out to 200 basis points.
Not only will rates go down to compensate you, but if you had a credit issue in 2019, you could take them all the way to zero.
Yeah.
And if you're in Europe, you could take rates to negative if you had to bring down those rates. So yes, that credit spread widens, but you could go so far down with that interest rate, the Fed can, and market-based rates that you could still drag them down. What I'm saying now is that the floor on interest rates is not zero or negative like it was in 2019, negative being in Europe and Japan, but it's like 2.5. So the Fed's got 300 basis points to cut. They wouldn't do it all at once. And if credit spreads widen 300 basis points, interest rates don't move, is what happens. The composition changes, but not the overall level.
That makes sense. Well, we're at a crypto conference, Jim, so I got to ask you your views on crypto, how they've changed over the few years, and also the final question on the panel we were at with Mark and Urian. I asked something to the effect of, in one word, what will be the impact of macro on crypto over the next, I think I said 12 months? A headwind, a tailwind, or it doesn't matter? What was your answer? And explain why you said that.
I said it would be a headwind. I said it'd be a headwind because of higher interest rates. As I said earlier, every investment is an option, right? If you're a crypto investor, you can invest in the TradFi markets. If you're a crypto investor, you could stake your coins, you could put them in a liquidity pool, you can earn interest. 5-6% interest on a Uniswap pool. You could get from Lido or some other staking service, you could get 3-4%. That was great in 2020 because you could leave your money in a money market fund and get zero. Now you get 5.5% from the government without any risk. So now you have to start thinking, if I buy these coins and I stake them, I get the same interest rates as the government. Now I'm betting that the coin prices are going to go up. But that hasn't been working for the last 18 months or 2 years. In fact, a lot of these coin prices are down a lot since people have bought. And I'm talking, when I talk about coin prices, I'm really going beyond Bitcoin and Ethereum, into the next level, not necessarily all the shit coins, but, the next level behind them, not the stables, but, you could even throw in the stables because you could stake those and you could put those in liquidity pools on Curve and stuff and get some interest rates. So the reason that I say interest rates matter is because there's always an option. I could put my money in crypto or I could put it in TradFi. Within crypto, I could also stake it and I could get an interest rate compared to what I could get in TradFi. And as those rates go up, those options get higher. I explained it the other way, right? I could buy the stock market if I'm a young person and say, I don't care if it goes up or down over many, many years, it's going to go up 9 or 10%. I could put my money in a money market fund and get more than half that with no risk whatsoever. That is much different than 2019 when my option was zero. So I think that the headwinds of macro are going to remain with crypto unless they can break free of that. Now, what I mean by break free of that is we all know that crypto, what it really needs is it needs adoption. It needs people to be dragged into the market as well. I happen to think, we didn't talk about this on the panel, but I happen to think that where crypto is going to see its adoption is in the letters RWA, real world assets. And this morning in one of the panels, Rob Leshner, formerly of Compound, was saying, I got news for you guys, and I'm going to really rain on your parade. The institutions aren't coming to crypto. And what he meant was, they're not going to say, oh, wow, look at crypto. We got to get in there. We got to buy Chainlink. We got to buy Uniswap. We got to buy Ethereum. They're not interested in any of that stuff. We got to buy Solana. They're not interested in that. What they are interested in is look at DeFi and look at the cool things you could do with DeFi. Let's trade the S&P 500 that way. Let's trade bonds that way. Let's tokenize real estate and trade real estate that way. Let's take our assets, stick them on there. And if you're waiting for them to buy Solana or Ethereum or a Chainlink or Uniswap, they're not going to buy those. Now, the Solanas, the Chainlinks, and the Uniswaps could benefit because those real world assets could become trillions of dollars and generate huge fees for the holders of those protocol tokens or for those utility or some of the utility tokens. But if you think that the JP Morgans and the Goldman Sachs are going to show up to buy Chainlink, they're not. They're going to show up and say, I like your DeFi thing. We're going to trade the S&P this way, is what they're going to do. So that's where the adoption, I think, for crypto is going to come. What really kills that, in my opinion, whenever I talk to institutions that want to do that, it really looks good. And then there's a hack or there's an exploit. We can't do this. We can't do this. As I've said to a lot of my developer friends in this space, you guys came out of the gaming industry. You could put up a 1.0 that's kind of buggy and then put up a 1.1 and a 2.0 and a 3.0. There's two industries you cannot do that with, that they have to be perfect from the get-go.
Can I guess what they are? Medicine and finance.
Yes, healthcare and finance.
Yeah.
Because people lose their money or they die.
Yeah.
If you put up a protocol,
can't mess around.
Yes, if you put up a protocol or a bridge and it gets hacked, Grindr's looking for developers. Go work over there, because you cannot make that and I'm serious. Grindr is looking for developers. Yeah. You cannot make that mistake in this industry. So you've got all these institutions lined up going, man, we should look at this DeFi stuff. And then there's a hack or an exploit. It ain't ready. It ain't ready. You cannot make that mistake. And yet they, like I said, they have that gaming mentality. Throw it out there halfway done and we'll keep fixing it, make it better along the way. It's fine. If I'm playing a game and the game gives me the blue screen of death, no one dies.
Yeah.
No one loses their money. They're just frustrated for 5 minutes. But in this industry, people lose all their money. In healthcare, they die, and you can't do that. And that's the biggest problem they have. So once they kind of get that resolved, and then there's the UI, UX thing, where is it easy to use? Once they get that resolved, I think where the adoption comes from is real world assets come plowing into it. Last thought for you. Yeah. There is one real world asset that everybody calls in this conference calls the killer app for crypto, stablecoins. Stablecoins are just a representative of the dollar. That's a real world asset. That's really where the adoption is going to come from. But I think that the people that are waiting for everybody to discover Chainlink or Solana or Ethereum and want to bid those coins to the moon, I don't think that the institutions, the Blockrocks, the Goldman Sachses of the world, that's not what they're going to do. They're going to bring the S&P 500 and bonds and real estate to this space once they feel like the technology is stable enough that they can trust it.
So I agree with you, and I have long believed that for crypto to grow, it does have to be attached to the real world and does have to have claims on real assets, housing, stocks, all this. In the same way that if you own a stock, you participate in the share of its future cash flows, or a bond, you have a certain guarantee. Probably most of those are securities. If the crypto gets a larger claim of the real world assets, and you do have the S&P 500 on a blockchain, or you do have houses trading in some sort of a security, a mortgage-backed security on a blockchain, by definition, wouldn't those things be securities, and wouldn't they have to be regulated? And by the way, you can't have blockchain associated tokens you can't have Tesla coin. Okay, and because is it backed by Tesla share? It's a synthetic. That's.
So two things. Let me take the last part first. So synthetic, a protocol used to trade Apple, Tesla, the S&P 500. The difference there was that they were inventing it out of whole cloth. And the fear that you have when you do it that way is you could create Tesla shares synthetically into infinity. And you could devalue all the Tesla shares because you could create these into infinity. What we're talking about here is you take one Tesla share out of the TradFi market, tokenize it, put that one Tesla share into the digital market. You haven't changed the supply of Tesla shares. You've just changed where they're traded. That can work. Well, the synthetics problem was you were giving them the ability to invent Tesla shares out of whole cloth.
I agree with you. Yeah.
Yeah. To your first point, are they securities? By the definitions that we have of securities, yes, probably. But there are bills in Congress, and we have to start to redefine that. If you want to hang your hat on us, we have these securities laws, and we have to follow the securities laws, the Howey test, and all these other things that we talk about with securities laws. Fine. The rest of the world's going to move beyond this, and they're going to leave us behind. But if we have to recognize this is the future of finance, and that's why I've been so high on it, it is the future of finance, we have to adjust and move along with it. And if we want to just say it's all scammers and hacks and it's fraud and no one can touch it, then we'll just let the Middle East and Singapore become the new financial centers, and we will be left out, because the next thing they'll do when they're the new financial centers is they'll find a new reserve currency. and they will leave us out. We have to be part of this, of evolution that is happening in the world. You cannot put this genie back in the bottle with what's been happening with digital finance or with cryptocurrencies, and we have to move along with it. Yes, we developed the Howey test in the 1940s for orange grove trees, and it worked well in the 1940s for orange grove trees. But in 2023, when we're talking about digital assets, it doesn't work well for digital assets.
But what if you tokenize something that is a security? You know what I mean? Like tokenize S&P 500.
Yes.
Or tokenize Tesla share. Is that a security?
It could very well be. It could very well be a security. I'm not an expert on securities law, but if the answer should be the government, the legislators, the regulators should say, here's how you should or can do it. Instead, their answer is, you can't do it.
Yeah.
And the problem that they're going to face is somebody in Singapore or somebody in Dubai or even somebody in London, because Rishi Sunak, the Prime Minister of the UK, is very, very open to crypto. They will let them do it. And then all of the business will move away from us to them. So that's the thing, is that what I hear from regulators is, no, you can't do it. Instead of, let's work together to find a way that you can do it without it being disruptive or injure the current system that we have. And that's a mindset that we're not ready to go with. But more and more, that mindset is changing towards, let's figure out ways to do it. You interviewed Hester Pierce here, and she's been on the leading edge among regulators to figure out ways to open the doors to allow this to happen.
Yeah, I mean, you're much more familiar. I did speak with Commissioner Pierce of the SEC. You're much more familiar with her work than I am. But what she said in the interview is, she says it's Congress's job. I think her view is the SEC. She's against the crackdown. She's against the regulation by enforcement. Stern critic of that. But I don't know if she is proposing an alternative regulatory framework. She's saying it's Congress's job.
She's right, because the job of a regulator is, you're given a set of rules.
Yeah.
Make sure everybody follows the rules.
And she's saying this is not within the SEC scope.
Right.
Yeah.
The set of rules that the SEC was given was before we even invented digital assets. And now we've invented something that doesn't quite fit those rules. And we're trying to force that square peg into the round hole, is what she's trying to say. And she's 100% right. We need Congress to come back and give us a new set of rules for these new assets. You cannot keep forcing these assets into citrus grove shares from the 1940s. That's the Howey test when the Supreme Court came up with it. We need a new set of rules. And Chairman Gensler says, no, we don't. We can do it just fine with the rules we have. Yeah, and his answer is, you can't do any of it, is what his answer is. But like I said, they're doing it overseas. Is that where you want finance to be? Is in some country other than the United States? Because when that happens, the reserve currency is going to go there too. Maybe it's not Singapore, but it's just not here. And that's the risk. I think there are more and more people in Congress under the age of 2000 that are starting to get it, that this is kind of important. But those that are in Congress over the age of 2000 are really kind of pushing back on it. And the reason I jokingly say that is, to me, it doesn't seem like it's a partisan thing. I mean, it sort of kind of looks partisan. It's really, older members of Congress don't understand it and they're against it. Younger members of Congress kind of get it and are in favor of it. And do we have to just wait for them to die, in order to have some kind? There's an old saying in the scientific community that progress is made one funeral at a time. I mean, maybe that's what happens in finance now too, as well.
Yeah, well, Jim, we got to leave it on a happier note than that.
Well, the happy note is, I think it's coming. It's coming. Those changes, and this is coming to this industry. It's just, it's been more painful than we thought, but it is coming.
So on the one hand, you said, okay, it should be totally laissez-faire, no regulation. And on the other side, it's everyone's a criminal. We need a regulatory crackdown, regulation by enforcement. What about it? Just meet in the middle and say, hey, look, you have to have rules. In the same way, if Tesla reports a quarterly earnings report, they file something with the SEC or file it with some exchange. It doesn't have to be the SEC. You have to have transparency, and you have to have, where it's not professionals who are spending 100 hours a week on chain who only know what the hell is going on. You have to have, transparency.
Before the 1980s, just one thought for you. We used to have a thing called bearer bonds. And a bearer bond was a bond. It had no name on it. If you held that piece of paper.
It was like cash.
Yeah, if you held that piece of paper in your hand, you were the owner of that bearer bond.
So a very incentive to steal.
Well, yes, but what I'm getting at is it was the ultimate decentralized asset.
Yeah.
We're trying to create a digital version of that in decentralized assets that, there is no KYC or AML. There was no KYC or AML in bearer bonds. Well, we didn't have those rules, but even if we did, you couldn't because of the very nature of it. We're trying to create a digital version of a bearer bond in this business as well. So yeah, you don't necessarily want to have complete laissez-faire because then it's whoever hacks the last wins.
Yeah.
And that's not the way to do it either. You don't want to say, no, you can't do it. You want to find somewhere in the middle, but I think what you want to allow the ability to do is have some anonymity that I can own these assets. You can look on an ether scan or a block scan. You could see the 64-digit letter numbers that this account owns this, but you don't know it's my account unless I decide to purposely tell you it's my account. And so, but that's really where I think the hangup is that they're so afraid to allow that anonymity in order to own these assets because they come up with this idea, well, then it opens it up for drug dealing and illicit activities. I got news for you. That stuff has been going on for 1,000 years. It's going on now with all the rules.
With cash.
Right. We can't allow digital assets because the drug dealers are coming in. Oh, we have no drug dealing problem now? We have the biggest drug dealing problem we've ever had with all these AML and KYC rules. So I'm trying to leave it on a positive note that we are moving towards this and we are moving towards more financial freedom and we are moving towards more ubiquity in these digital assets. And I think it will be a good thing. And we're getting there. And when we get there, I think it will create more financial freedom for a lot of people. The financial system right now is really unfair for the poor, shuts out a lot of people. It's too complicated. What the digital system will do is it will make it very open and very accessible to people. One quick example about bringing digital into the world. The World Bank has done various studies of programs to lift people out of poverty in Africa. The program that has worked the best has been a program called M-Pesa. M-Pesa is run by Safari.com in Kenya. Safari.com is the mobile phone company. You can put money, and they use the old mobile phones, not even smartphones. You could put money on your mobile phone. And you can text that money to somebody else. So a poor farmer, everybody has a mobile phone in Africa. Poor farmer could be in town and he needs 50 cents to take a bus home. His wife could text him the money and then he could text it to the bus driver and he could get on the bus. That a poor farmer could go to another poor farmer and make a deal and he could text him money. Prior to that.
Similar to Venmo.
Right, yes, but it doesn't cost them anything. It's all free and it's instant. What prevented them from doing it in the past? Because the poor farmer would carry a bunch of Kenyan shillings in his pocket. He'd get mugged. And now he's worth zero because that's gone and he can't get it back. That program has lifted people out of poverty because you brought financial inclusion to the poor in Africa, poor in Kenya, and it has really lifted them out. And the World Bank has said a simple thing like that has been one of the most effective programs to lifting the poor out of poverty. Give them these tools to be able to do this stuff. And this is why I think the digital revolution has to come, because it will not just benefit the rich, it will benefit the poor. And the poor is Asia, Africa, and the Middle East. That's why it's so popular with the rest of the world. We're all rich Americans. We all like Venmo. We all like, E-Trade. Well, Venmo's great if you have in a bank account with several $1,000s in the bank and that you don't get charged fees. Okay, I've just excluded 98% of the world by just making that if you just had a bank account with several $1,000s, then you can use the Venmo app.
So wait, how do these people upload money under the phone?
The same way that
cash?
They pay their bills. They pay their phone bill. Okay. They can extra pay their phone bill.
Okay.
And then they have a credit balance with Safari.com. And then they could text that money to somebody else using their phone. So a poor farmer could go to another poor farmer and say, I want to buy your cow, and I could send you money, and we've made a transaction.
Yeah.
The fear was, if I was going to buy your cow, I would have to bring a bag of money and somebody hit me over the head and take my money. You can argue, well, they hit you over your head and take your phone, but it's not clear that you have money in, because they could come up to you and say, here's your phone, text me money, but I only have 83 cents in my account. Or I have $300 in my account. They don't know. But if you have a bag of money, they know that, and you're going to buy a cow, they know that. So it really does allow for the ubiquity that, that I can get money from my wife to pay for my bus ticket and stuff. And it's really helped the poor.
Yeah. And you can actually pay for the bus ticket with your phone. Unlike in Venmo, Venmo is great, but I don't know if I can pay with a bus ticket. I've never done it.
I think a lot of people, if a lot of people look at the money transfer systems or the money payment systems in the rest of the world, you will look at the U.S. as being the most backward of all the countries. In India, they've got an iris scan system
for consumer finance.
Right.
Yeah.
Look, we all think
you gotta go.
No, I'm looking at my watch and we're
saying,
saying we all think that this is really cool technology that I could just use my watch to pay Apple Pay. In India, you can walk into a store and you scan your eye.
Yeah.
And you pay. You don't even need to have this. You just need an eyeball and you can. That's India. In the United States, we are the backward country right now in the United States. And all of these programs really enable the poor to be lifted out. That's why I'm such a big fan of digital finance and getting rid of remittance payments and stuff, and helping the poor. Last thought for you. The average remittance payment you work in the United States as in housekeeping for a big hotel.
You got family
in Ecuador. It costs you 15% of your paycheck in 2 weeks to send you money back to Ecuador. Let me restate that. You work 1 month a year to pay the bank, send your money to your family in Ecuador. That's outrageous. That is outrageous. It should be instant and cost nothing. It is in some parts of the world. It is not yet if you work in the United States. The system is Byzantine, slow, and horribly expensive. And I would argue on purpose. And so trying to bring that away. Bukali tried to do that in El Salvador by bringing Bitcoin and bringing Bitcoin transfers to people in El Salvador. That's what he was trying to get rid of. You can argue whether or not it's been successful, but that's what they're trying to get rid of. We in the United States, this should have been eliminated 50 years ago in the United States.
But is it going to be a stable coin that does all this stuff? Because Bitcoin, it's great at going up. We all know that. But it's kind of too hard money. It's too hard of money to buy coffee with. That's what I would say. So
right.
It would be a stable coin.
It could very well be a stable coin. It could even be on the Bitcoin blockchain. But we're at a crypto conference. This is why, as a traditional TradFi guy, I look at this and I say, this is the future of finance. This is where we're going with a lot of this stuff.
Yeah, well, we'll leave it there. Jim Bianco on Twitter. You're killing it at Bianco Research. Thank you so much for joining us. And thank you to Kraken for letting us. I've been at podcast. This is the best podcast booth I've ever been in my life.
Thank you.
Yeah.
I really appreciate that. Coming from you,
Thanks, Jim.
That is quite the compliment.
Thanks.
Thank you very much.
Bye.